Hello everybody, I'm your lecturer, Hisham Osman.
Yes.
I'm doing the online lecture now. Okay, this is the topic 2. We have done this last week, so I have to finish this chapter. So remember that topic 2 is about the accounting process. So just remember the definition of accounting. Accounting is the process to analyze and record financial transaction and to report the financial information. In this chapter, you will learn about how to do an accounting record for a business. Okay, remember that the accounting process is started after a business transaction happen. So there are many types of business transactions. Let's say okay, if you have a business, you purchase something or you sell something that is a transaction. You pay the salary of the workers, you pay rental, etc. They are all business transactions. The accounting process is started after you made an a business transaction. Okay, the process of doing the accounting record uh, is called accounting cycle in the journal. And then after you have recorded all the transaction in the journal, you have to do the step 3, which is to transfer all the journal records in the ledger. The ledger is another book. It contains many T accounts. After you have transferred all the journal transactions into the ledger, you have to close the accounts and you have to do the step 4, which is to prepare the trial balance. After you have prepared the trial balance, you have to do the step 5, which is doing the adjusted entries. And then you do the step 6, which is preparing a new trial balance, which is called the adjusted trial balance. After you have prepared the adjusted trial balance, you can do the step 7, which is to prepare the financial statement for the business. And step 8 is doing the closing entries. Okay, let's see what is the first step in detail. What is the analysis step? Okay, to do the analysis, it means that you have to know the type of the transaction and then to identify the effect of the transactions on the accounting equation. The accounting equation is the assets always equal to the liabilities plus the owner's equity. So we have discussed this in the class. So we have discussed several examples on how one business transaction will affect the accounting equation. So remember last week we have discussed when a business borrow money from, let's say, a bank, then the effect of the transaction on the accounting equation is the asset cash will increase and the liability, which is the bank loan, also will increase. And the second example that we have discussed last week is, let's say, the owner of the business add 5,000 capital into the business. So what will happen to the accounting equation? The asset cash will increase and there is no effect on liability, but the owner's equity, which is the account capital, also will increase. And the third example that we have discussed last week is let's say you have a business and your business pay back the bank loan. So what will happen to your asset when your business pay back bank loan? The asset cash will decrease, and at the same time, the liability, which is the bank loan, also will increase by the same number. Okay, this is the analysis step. In this course, you have to know how to prepare the general journal only. In this course, all business transactions will be recorded in the general journal. To do the general journal, you have to know the rule of debit and credit. Debit means left, credit means right. So if somebody said you have to debit this account, it means that you have to record the account in the left side. If somebody says that you have to credit an account, then it means that you have to record the, the transaction in the right side of the account. So you have to memorize this. Okay, for assets, when there is an increase in asset, you have to debit the account. When there is a decrease in the asset, you have to credit the account. When for liabilities, an increase in liabilities, you have to debit. For liabilities, an increase in liabilities, you have to credit the account, and a decrease in liabilities, you have to debit the account. Also, for the owner's equity, if there is an increase in the owner's equity, you have to credit the account. And if there is a decrease in the owner's equity, you have to debit the account. Okay, the owner's equity account. The owner's equity is related to 4 accounts: capital, withdrawal, revenue, and expenses. If there is an increase in capital, you have to credit the account. If there is an increase in the withdrawal, you have to debit the account. If there is an increase in revenue, you have to credit the account. If there is an increase in expense, then you have to debit the account. Okay. These rules of debit and credit, you have to memorize these rules. Okay, these are the common account names that we use in accounting. For current assets, the common accounts that you will use is the cash, and then account receivable, and then the inventory and supplies. For non-current assets, the common or typical accounts that you have to use is the land, building, furniture, and the equipment. Another one is motor vehicle. For the current liabilities, the common accounts are account payable, salaries payable, overdraft, and interest payable. For long-term liabilities, most of the time, it is the long-term loan. So the equity account, there are two common accounts related to the equity is the capital, and then another one is drawing. So, and then you always use the account revenue to record revenue of the business. In this course, the focus is on the service business, So every service business, they provide service and they will get the revenue. So their revenue is called service revenue. And then you have expenses. There are many expenses. So the examples that we have here are salaries, rent expense, advertising expense, transportation expense, utilities, and accounting fees. Okay, this is the format that you have to use when you prepare or when you record a transaction in the general journal. So the first thing that you have to write when you record in the general journal is you have to write the date of the transaction, and then you have to write the debit entry and the amount. And then you have to write the credit entry and the amount. The credit entry has to be written a bit in the right side of the you have to write it a bit in the right side. See the format here? So you have to follow this format. So, so example 1. A business purchase supplies $250 and the purchase is made on account. So on account means the business will pay the $250 to the supplier later. Okay. Now, how to record this in the general journal? So remember, to record this in the general journal, you have to analyze this transaction first. So the type of the transaction is the business purchase supplies on account or in credit. So what is the effect of this transaction on the accounting equation? So the effect is asset supplies increase 250, and then the second effect in the accounting equation is liability, which is the account payable, also will increase by 250. So asset increases 250 and at the same time liability increases by 250 also. So when you want to make the journal entry in the general journal, you have to use the accounting equation, the rule of debit and credit. So asset increases, you have to record in the debit side. So see here, the supplies is an asset. So asset increases, you debit. So debit account supplies 250 and the account payable is the liability. Remember the rule of debit and credit says liability increases, you have to credit account. So you credit account payable 250. Okay, let's see another example. Okay, this is another example of a business transaction. You have a business and then one day you receive a check 1,000 from a customer after you have provided a service. So how to record this transaction? So this transaction is a cash service transaction. You have a business, you provide a service to a customer, then the customer pay cash $1,000. So to do the journal entry for this transaction, you have to know the effect of this transaction on the accounting equation first. So what is the effect of this transaction on asset? So when the customer pay, the effect is asset cash increases by 1,000 And then at the same time, this is a service revenue. Revenue is related to the owner's equity. So revenue increases. The equity increases. The account is account revenue. The amount is 1,000. So you have analyzed this transaction and then you can record in the journal. So to record in the journal, you use the rule of debit and credit. Asset increases, you debit. So you debit account cash 1,000 and the equity also increases. When the equity increases, you have to credit the account. So you credit account service revenue 1,000. So now this is example number 3. Um, you have a business, let's say you have a business and then one day you provide services to a customer in credit for 750. It means that you provide the service today and then the customer will pay later. The amount related to the service is 750. So you have to make the journal entries. How to do that? Remember, you have to do the step 1 first. In the step 1 in the counter cycle, you have to analyze this transaction first. Then the type of the transaction is providing a service in credit. So what is the effect of this transaction on the asset, liability and equity? So first, when you provide a service, the customer owe you your business 750. So when the customer owe you your business 750, it is an asset because the business will get $750 in the future. So asset increases. The name of the asset is account receivable. The amount is 750. There is no effect on the liability, but there is an effect on the equity, which is the account revenue. The revenue increases by 750. Remember, you have to record the revenue when the transaction happened. Okay, the transaction happened today, then you have to record the revenue today. Even though the business will receive the cash later. You record the revenue when it happens. So you know that asset increases and also revenue increases. So the journal entry is asset increases, you debit, so you debit account receivable, and then the revenue increases, you credit account service revenue 750. Okay, this is how the general journal look like. So if you have a general journal, when you record the general journal, you have the journal is like a book. So when the transaction happen, you think or analyze, and then you record in the book. So see here, there are 3 transactions happen in different dates. Okay, after you have to record all the business transactions in the journal book. Let's say you have a business, let's say the business is started from 1st of January. So you have to record all the transaction. Let's say you will close the account of your business at 31st of December. So every day you have, when the transaction happen, you analyze and then you record in the journal, every transaction. At the end of the year, at the 31st of December, you have to stop. Then you do this step 3, which is the to prepare the ledgers. Okay. The step 3, the process of doing step 3 is you have to transfer or post all journal entries to the ledger. Ledger is another book. It means that in step 3, you have to transfer all the journal entries that you make in the journal to another book, which is the ledger. So after you have transferred all the journal entries into the ledger, into the accounts, you have to close the accounts and you have to calculate the balance for every account. Let's say in your ledger you have cash account, so you have to close the cash account and then you have to calculate what is the balance of the account at the date when you close the account. And then you have account receivable. So you have to transfer all the journal entries into the account receivable, and then you have to close the account, and then you have to calculate the balance for the account receivable. So you have to do this for every account that you have in the ledger. Okay, after you got the balances for every account in the ledger, you go to the number 4, which is to prepare a trial balance for the business. A trial balance is a list of all account balances, a list of all accounts with their balances. Okay, the main reason why you prepare a trial balance is you want to check whether the recording the process that you have done in step 1, 2, and 3 are correct. This is the format for a trial balance. Okay, let's see in this example. The date is supposed to be December 31st, 2019. Okay, so in the trial balance, you have to list all the accounts with their balances. See here, there are cash account, account receivable, inventory, land, account payable, capital stock, retained earnings, sales revenue, cost of goods sold, advertising expenses, miscellaneous expenses. So this is an example of a trial balance of a business. So this business has 11 accounts. So in the trial balance, the business has to list or to show all the accounts with the balances of the account. You can see here the cash account has a debit balance. Account receivable, inventory, and land also have debit balances. But the account payable, the capital, retained earnings, and sales revenue, they have credit balances. Okay, account cost of goods sold, advertising expense, and miscellaneous expenses, they have debit balances. So you can see here the total amount in the debit side equal to the total in the credit side. So if this is your business, when you prepare the trial balance, you see that the total in the debit side is equal to the total in the credit side. So when these two totals are equal, most of the time the accounting process you have done in step 1, 2, and 3 are correct. If the total are different, the totals are different, or the total in the debit side does not equal to the total in the credit side, then there is something wrong with the way you record the transaction in the step 1 or step 2 or step 3. Okay, this is a sample question. Uh, in this sample question, you can see business transactions. Okay, the sample question is like this. There is a business, and these are business transactions that happen for the month in the month of January. You can see here there is a transaction happen in the 1st of January, 2nd of January, 3rd of January, 10, 17, 24, 28, 29, 30, and 31st of January. So for this question, you are required to do first, you have to analyze the business transaction. This is the first step in the accounting cycle. After you analyze the business transaction, the second thing that is required is you have to record the transactions in the general journal. This one is the second step in the accounting cycle. And then the question asks you to do the step 3 in the accounting cycle, which is to post the journal entries to the ledger. And then after that, the question asks you to do the step 4 in the accounting cycle, which is to prepare a trial balance. Okay, you can try to answer these sample questions. And also, I will give you the answer later, so that you know how to do this sample question is given to you because I want you to know how to do the first 4 steps in the accounting cycle. Okay, so you have seen the way how to do the accounting record. Okay, the way to do the accounting record is by following the accounting cycle. You have seen how to do the first 4 steps in the accounting cycle. So another thing that you have the accounting record also can be done using computers, using softwares. There are several softwares, many softwares out there that can be used to do the accounting record. There are several advantages of using softwares in preparing the accounting record. For example, software and computers can process large amount of information very quickly. And also, the computer and software can produce many documents. For example, you want to print a receipt every time you provide a service. It is possible by using the software. And also, using software to do the accounting record can increase efficiency. But there are advantages of using software and computers when you prepare an accounting record. The first one is computer hardware and software require human judgment and input. The software and computer are tools, but you as a human or as a business owner or as an accountant, you have to use your judgment. Okay, the second disadvantage of using computer is garbage in, garbage out. It means that if you put a wrong number or you record in the wrong place or account, then the output of your software is also wrong. The third disadvantage of using software and computers in preparing the accounting record is once an error is identified, fixing the problem may require many adjustments. Okay, thank you very much. I hope I can see you in the future and help you to understand and master this topic. Thank you very much. I hope everybody are well and see you later.